to get to those first a second. I hate to do those first because we need to make sure we finish this chapter. Let's go ahead and go through the chapter first, and then we'll get to the questions after. Okay, so we covered impulsive patterns last time and realized that chapter 5 of my book is primarily what all books on LA Wave cover. So it's more of just the basic foundational concepts, even though I do go into a lot more detail about the specific related channeling of each pattern. But it's pretty much what on LA Wave. So when it comes to corrections, the most important thing to realize is that you get to the corrective category mostly because whatever you're looking at didn't follow impulsive rules. So it's a default phenomenon. So if you look at a pattern and it doesn't follow the rules of an impulsive pattern, by default, it's assumed to be corrective. So that's how you would get here. You wouldn't assume something is corrective first. You would assume it's impulsive first, and then through elimination, you would move on to corrective patterns. Now, as you get really used to market action and get used to observing the way one wave reacts in relation to another, you won't have to go through that process. You'll just immediately probably know if something's corrective. Sometimes impulsive patterns are more difficult to be certain of. It's a lot easier in advance. It takes, say, 10 points in 1 day, followed by a decline that takes 9 points in 10 days. Well, then you know the advance is corrective and the post movement or the move after is corrective, and that's kind of a flat structure. But that may take time for some of you to get used to that. Okay, so again, as default, if something doesn't follow impulsive rules, then it is assumed to be corrective. So that's where this discussion, that's what this is covering right there. So let's move on to the first type of correction. I've actually shrunk the size of the letters here. It actually makes it look a lot more like my book this way. I didn't realize I could do that. So when you're dealing with the core foundation of wave theory, you have 3 types of patterns: zigzags, which are trending corrections; you have flats, which are mostly horizontal consolidations; and you have triangles, which are expanding or contracting horizontal consolidations. And to do zigzags and flats, you need 3 segments, triangles 5. You know you're in a zigzag because you have the potential for a 5-3-5 sequence in a flat. The first move is retraced more than 61%, so that eliminates the possibility of the 5. So you make it a 3, and then the last segment needs to be impulsive. And if all of them retrace each other a lot and the market continues on the third segment and just continues to contract or expand, then you would assume a triangle kind of environment. Now, it's not really necessary for me to go through all the different details of flats and zigzags because it's well described in the book, and it's not really that important to know what kind of variation you're in. The most important thing is just to know whether you're most likely in a flat or a zigzag or a triangle. And the best way to differentiate those is first move, which you're calling wave A, is retrace less than 61%, then you would eliminate the flat category. Still could be a triangle, not very likely, but still could be, but is most likely a zigzag. If the first move is retraced more than 61%, then you eliminate the zigzag category and you keep flat and triangle. Then the next thing you're going to want to do is look at the behavior of wave A in relation to wave B. If you're in a triangle, wave A is going to be very violent, especially if it's a contracting triangle. If you're in a flat, it's going to be less violent, maybe more like a zigzag, but it won't be quite so catastrophic in relation to surrounding price action. Things will be going along just fine in a market. All of a sudden, you get this vertical collapse, like the crash of '87 was the start of a contracting triangle. The crash, I think, of 1929 was the start of a contracting triangle. That was a much larger scale crash, but when you shrink it down to yearly charts, it becomes a very violent decline. So it's a relative phenomenon, and remember, this is all managed properly by controlling complexity on your chart. You're not going to draw a chart of the, say, 1920s to 1960s and have it on a daily chart. You're not going to see proper behavior relationships doing that. You need to shrink it down, go to larger and larger time frames until the crash of 1929 looks like mostly a mono wave, or maybe 2 waves, maybe 3 waves. But then after that, everything becomes much more time consuming and complicated. So you can say that wave A is clearly the most violent. Wave B takes a lot more time. Wave C relates to wave A, by Fibonacci relationship, and so forth. So going back to what I was saying earlier with the 3 different patterns, it's just a matter of looking at, yeah, you definitely want to use log scale on any price movement that covers lots of territory. So if the market's going from 10 to 11 or 100 to 110, log scales aren't there that necessary. But if you're talking about a move going from 100 to 200, 400 to 1,000, something like that, you always want to use log scales when the movement on the chart is more than doubling for sure, and even going up 50%, you probably should move to log scale. If it's just 5 or 10% moves in either direction, log scale is not necessary, but with computers today, the process is pretty easy, so it's not a big deal. If you want to be safe, just use log on everything you do, and you'll be in much better shape that way, and all your relationships will be proper. Okay, so back to the simple discussion regarding zigzags, flats, and triangles. If your first move is retraced more than 61%, you're dropping the zigzag possibility and just focusing on flats and triangles. And if the first move is much more violent than the surrounding or than the most recent action that you've seen, then most likely it's wave A of a triangle. If it's more normal looking, then you're probably dealing. That's the first step in differentiating between zigzags, flats, and triangles. Now, all the rest of the variational possibilities, they're not that crucial to know every single name. A strong B wave just means that it's bigger than wave A. A normal B wave means it's about the same size as wave A. It gives it a range between about 80 and 100%, or 81 and 100% of wave A. And a weak B wave would be where the B wave is somewhere between 61 and 80% of wave A. But in all cases, to make it part of a flat, you want the B wave to retrace at least 61% of wave A. So if you're moving into zigzag territory, most likely, and with rare exceptions, possibly a neutral triangle or a rare contracting triangle with under very bizarre circumstances. But most of the time, if the B wave is less than 61%, you're dealing with a zigzag. Moving on. So it's moving on to the zigzag category. In this case, you want to have the B wave no more than 61%. So it's the dividing line between flats and zigzags. More than 61, you're dealing with a flat. Less than 61, you're dealing with a zigzag. If it's right at 61, you really can't be sure, and you'll have to wait to see how wave C behaves and what happens after that. So it's right around 61% that it becomes unclear. Most of the time it won't make sense. But in a zigzag, the C wave is more likely to be similar to wave A. In a flat, it might be related by 61% if wave B is only 61% of wave A, but there's no hard set rule. If the B wave is 61% of wave A, then you're in a sort of a nebulous world and you can't really say for sure, but it won't make a lot of difference because the reaction after it's over will still be very similar to whether it's a zigzag or a flat. Here shows some minimum examples. If you're dealing with zigzag on a very simple chart, remember there's the potential for missing wave action. So let's say the market had declined from here to here for one period. And let's see, actually let's say that the high was here, the market dropped to here. And during the formation of this, the market may have gone up. There's no way to really describe this easily. Let me see, this was a plot here, plot there. Let's say the market had declined and the low happened first and the high happened second. Okay, but the market that had topped here, it dropped, and then before the day was over, this is how it happened. If the high happened first, low happened second, but before this day was over, the market bounced a lot intraday, but then by the opening of the next day, this turned out to be the high and the low. So there's a possibility there's missing action on an hourly basis that you can't see, and that would create a situation like this. But just realize 9 times out of 10, if you see a B wave that looks like this, there's some missing action intra-day, intra-bar, intra-hour that happened that you don't see, and that it most likely was a bigger bounce than this. It'd be very, very unusual to have a bounce that looks like that without some higher low being hidden in the price structure. But to qualify as a legitimate counter trend move, it does have to bounce at least a little bit. And then the C wave, if this really were a zigzag, you'd want the C wave to preferably be equal to or relate to wave A. but you may have to go to intraday charts and look for a high that happened in here to get the true relationship between wave C and wave A. But this would be the minimum requirement for the B wave of zigzag, even though it really should not happen this way. I would accept this more if it were an X wave than if it were a B wave of any kind of pattern. Okay, I think I just went forward by accident. So the maximum in a zigzag is 61%, and the minimum for wave C in a zigzag is it needs to break the bottom of wave A if it's going down, or the top of wave A if it's going up. So you can't have the B wave end here and the C wave fail to make a new low. That wouldn't qualify as a zigzag. It might be a triangle. It might be part of a correction where this is not wave B, but it's wave A of wave B. But you can't have the C wave finish above wave A in a zigzag. Especially the weaker the B wave is, the more mandatory it becomes that the C wave has to make a new low for any pattern. But in a zigzag, it does have to make a new low. In a flat, it may not if the B wave goes, higher and higher. It's most common when you're in a zigzag that whatever wave A does, wave B is going to take more time and more complexity. So if wave A is a mono wave B is likely to be 3 mono waves. If wave B is 3, it's likely to be 5 or more. So just always accept the odds are extremely high. The B wave is going to be more complicated and more time consuming than wave A in both a zigzag and a flat. It's mandatory in a flat. It's also extremely likely in a zigzag. If the B wave takes less time than wave A, you're not in a zigzag and you're not in a flat. You're only potentially in a triangle, or your entire count is wrong. So remember, it's crucial. Just like wave 2 has to take the same amount of time or more as wave 1, wave 4 has to take wave 3 in standard impulsive patterns. The B wave has to take as much time or more as wave A in flats and zigzags. It can only take less if you're in a triangle or a diametric, but not in flats or zigzags. But you see people do this all the time, and that's why most orthodox LE wave analysts are always changing the counts while they have multiple different scenarios, scenario number 1, 2, 3, and 4. And that's not a great way to trade. It doesn't make things very easy. So if you follow these rules, you'll help to eliminate a lot of that uncertainty in a lot of these multiple scenarios, and you'll hone in on one good count, the majority of the time at least. As far as the maximum and minimum length, wave C should be at least 38% of wave A and no more than 61% of wave A. So if wave C is more than 161%, you're probably dealing with a 1, 2, 3, not an ABC. This diagram isn't, let's see, the B wave looks like it might be equal to wave A. Let me just double check. Don't think I can actually draw. Yeah, the B wave takes more time than wave A. So this B wave is legitimate. It takes more time than wave A. It probably retraces a little bit less than 38%, which I would prefer if it's at least 38%. So you might want to put a little note on here. For a good zigzag, the B wave should be at least 38 or 33%. Being less than that is questionable. There could be missing price action, but it depends on how simple your chart is. Remember, the simpler the chart, the more leeway you can give in all structure. If it's just a simple 1, 2, 3, one mono wave, one mono wave, and one mono wave, well then yes, you can tolerate this as an ABC. The more the complexity increases, the less you can tolerate a B wave that's less than 33% of wave A, the less you can tolerate a B wave that's the same complexity as wave A. You want it to be more complicated and so forth. So in a standard zigzag, the C wave will be somewhere between 61% and 161% of wave A in length. If it's smaller, it becomes questionable. If it's larger, it becomes questionable. So if it's smaller, you're probably looking at a correction after wave A. So this is wave A, and you might go A, B, C, A, B, C, and that whole thing would just be the B wave before a big C wave decline. So be very careful about requiring these minimum price moves for patterns to consider them to be the same degree. Remember, it goes back to the 1/3 and 3 times rule. And if it's less than 1/3 of the price, less than 1/3 of the time, less than 1/3 of the complexity, it's probably a lower degree. So if it's less than 38% or certainly less than 33%, then that's less than 1/3, and it moves it into a lower degree range. So if you follow those rules, then it helps to prevent you from believing things are going to happen let's move on. The C wave, which is right on the borderline of being an acceptable C wave. The B wave doesn't take enough time in relation to wave A, so you would want this B wave to be more time consuming and more complicated, most likely. But the C wave, I think here is less than, let me just see if it's less. No, it's actually, it's a little bit more than 38. So this would qualify price-wise, but the B wave is not time consuming enough in this diagram. So just put a little note that you want the B wave to take more time and preferably retrace at least 33% of wave A. Again, if you're looking at a very simple diagram where this is all you see, then you can tolerate, the B wave looking like this because it's probably missing action that you can't see. The more complicated, the less you can tolerate a B wave that would behave this way. Okay, looks like we're getting quite a few questions in here. So Roy, you're saying, let's see, let me unlock your mic. Okay, so your mic's unmuted, Roy. So what are you asking about the 61.8%? So ABC or 1, 2, 3 still in play? What's the question there?
Yeah, zigzag is a classic Dow trap quite often, where people think it's made a lower peak and it's going to start a new downtrend, and of course the zigzag holding the 61.8, it leaves both A, B, C or 1, 2, 3 still in play. What's the minimum point in which you would say it's likely to be an ABC? Is it overlap?
Talking about a zigzag following an impulsive pattern or something like that?
Let's say we don't know the context and we see a zigzag just in isolation. Okay. I know it's. So
let's just use this one as an example.
Yep.
So what about it?
So at what point, like if we have a zigzag and B comes to 0.618, so still holding, so it could potentially be 1, 2, 3 or ABC. At what point would
no.
Yep.
It's not whether it's. I mean, if you assume you're in a correction and it's 61%, the B wave is 61% of wave A, you're not going to assume 1, 2, 3 or ABC. You would assume an ABC zigzag or an ABC flat, unless there's some reason you think there's a chance for an impulsive decline. Now, if you really don't know if a pattern is finished, you would want to pay attention to how this drop looks in relation to prior action, because if you're starting a new trend, this drop is going to be bigger and faster than almost anything you've seen for quite a long time. If it's more normal behavior and not retracing a significant amount, like if it's something like this and it hasn't retraced, beyond 61% of the previous move and it starts to bounce, the odds aren't so good that you're dealing with a new impulsive decline. You more likely would be dealing with a zigzag. Remember, the beginning of a major new trend, if this is going to be wave 1 of a major new trend, it's going to retrace most of this fairly quickly. So if it's comfortably less than 61% of the previous advance, then you're almost certainly talking about a corrected decline. Does that make sense?
Yeah. So you would look at the speed and look at the space of the retracement of the
right.
move up. Yep.
You look. This is a pretty big move. It's way bigger than the previous declines, but it's only 61% of the move, and then the market starts to bounce. So it really starts to raise serious questions about how serious this is. Looking at the speed of this move, I would probably want it to have dropped about twice as fast to about here and bounced, a small amount and not taking a lot of time to bounce to put us at risk of a much larger decline. The minute this move gets retraced more than 61%, then there's no way this is wave 1. And even if it gets to 61%, the longer it takes, the greater and greater odds it's not wave 1 and wave 2, but wave A and wave B.
Yep.
So
also the overlap, quite often, people comment about after a C wave, you get a move up that overlaps through A. Now, sometimes that may be a 3-2, for example. Let's say if you get the assumption wrong, rather than meaning that it's overlapping through A and maybe it's a zigzag. I don't know, what insights have you had about that?
I'm going to give you the ability to use your drawing tool if I can here. I'm trying to figure out how to do that. I don't know if I can. No, I can't. I don't see how to do that. I'm not really quite understanding your question. Can you ask?
In terms, one late validation some people use, and I'm not sure whether you apply it at all, is where once you're in the C wave down, let's say if we think it's a zigzag, then seeing the price action move back through the A line is.
Oh, you mean the zero B trend, trend line, or the A parallel line?
So let's say we have a zigzag A, B, C,
Yeah.
and then we think the zigzags, A, B, C, and then we see the next move up, and it passes over the A, the valley at A.
Top here or the bottom here?
Yeah, bottom. Yeah, overlaps through there. Now,
okay.
Does that for you add any weight that it's a zigzag, or not at all?
Remember, everything's based on post-pattern behavior. You have to remember, it's not just movement that counts. It has to be a certain type of speed and price movement and complexity. So the first thing you're going to watch for is your channel across 0 and B. And you're going to want to get to that channel less time than wave C took to form. That's confirmation, stage 1. That's the first thing you have to see before you can assume that the C wave is over. Okay. And if you retrace all of wave C in the same amount of time or less as wave C took to form, then you have near certainty that you just ended a zigzag. But until at least one of those happens, there's no chance that the C wave is finished.
Yeah. What if you, so let's say, so you're saying if we have a move from C that's fast, then
it has to be bigger and faster than wave B.
B. Okay. So bigger than faster. And would you also say if it retraces more than 61.8% of C, would you start adding some weight in, thinking look, the ABC is done?
No, because there's other things that have to happen. Remember, confirmation is not just a temporary event based on retracement. It's a speed and behavior and complexity event. So you have to break the 0B trend line in the same amount of time or less as wave C. That's stage 1. That gives you probably better than a 50% chance that wave C is over. Then the next thing that has to happen to prove that the C wave is concluded and is either wave A of a bigger pattern or the end of, say, wave 2 or wave 4 or some bigger structure, you have to retrace all of wave C in the same time or less as wave C took to form. So those are the two things you need to see to be sure the zigzag is over and that you're going to retrace at least 61% of the entire zigzag, because there's a chance the whole zigzag is just wave A of a bigger pattern. But if it's the end of, say, wave 2 or wave 4, then you're going to retrace this whole thing, not necessarily faster, but you're going to retrace it initially very quickly, the C wave very quickly, and the market's going to have to behave similar to what wave 3 or wave 1 did. You have to draw in channeling, make sure you don't break the 2-4 trend line. All these things have to be simultaneously considered. But the most important first step is you have to break the 0B trend line at the same time or less as wave C took to form. And to be really confident, you want to retrace all of wave C in the same time or less as wave C took to form.
Okay, thank you.
Okay, so it's not a retracement thing, it's a channeling, and it's not a 61% thing, it's a channeling and complete retracement observation.
Okay.
Okay. Okay, so I'm gonna go get rid of that question. Go ahead and put your mic on mute. Sukat says, if the B wave of a zigzag is less than a third of A, how can we interpret these two in the same degree? So Sukat, let me go ahead and unlock your mic. Okay, so it's currently unlocked. So can you explain to me what you're driving out there? Sukat, can you unlock your mic? I see you're unlocked according to my side. I don't hear anything though. Okay, let me go back to see if there's any others. Roy had another question. Let's see. A zigzag is a classic downshift. Can we know if it is likely? I think we just answered that question already, right, Roy? So I think we already just went through that. Let me delete that question. If I didn't fully answer it, Roy, just ask your question again, but I think we just did it. And Sukat, I can't hear you talking. So he's saying if the B wave of a zigzag is less than a third of wave A, how can we interpret those two in the same degree? Okay, if the B wave is less than a third, it depends on how complicated the chart is. If the B wave is one monowave, the A wave is a monowave, the C wave is a monowave, well then the B wave could be less than a third and it might be plausible there's some missing price action intraday or intra time frame that you can't see. If the B wave subdivides, 3, 5, 7 monowaves or more, and wave A subdivides also, then you're not going to tolerate a B wave that takes less than a third of wave A. That's when you're going to have to move into the triangle category, or what you think is wave B is really an X wave. And I can't think of any other situation that might apply to. So it'd either be an X wave or it's part of a triangle. So if that answers your question, Sukhet, you can say so in the question section, because I still don't hear any. It says you're self-muted. I don't know what's going on with that. Okay, and then and Roy, all retracements should be done on log scales unless you're dealing with price action that's in the same range for a while. Okay, so let's continue on. And again, I don't want y'all to spend a tremendous amount of time trying to memorize all these little variations, because the variations aren't that important. What's important is to know whether the B wave is weak or strong in all the different cases, because that's going to determine what the C wave can do. The weaker the B wave, the bigger the C wave. The stronger the B wave, the smaller the C wave is allowed to be. It doesn't have to be, but it's allowed to be. So if wave B is equal to wave A, then wave C might be 61% of wave A, it might be 100, it might be 161. It shouldn't be less than 38% ever in that kind of situation. But the B wave strength is what really tells you almost everything else you need to know. And when you're drawing channels, even though the diagrams in my book, just to show that strength and weakness, we'll get to those in a minute, but to show the strength and weakness, all the channeling in the book is horizontal. But when you're actually dealing with them in real time, you want to draw a trend line from the top of wave A to the top of wave B, or the bottom of wave A if the correction is going up to the bottom of wave B. And then you have a parallel most of the time across the other side to see where the C wave falls. And if it's breaking beyond the channel, then that would be a situation where the B wave is probably weaker, or you're in an expanding environment. If it doesn't reach the opposing trend line, then the C wave is implying strength, and the counter trend move will be stronger. You should think of all this structure like it's physical material in the real world or in outer space. So if you imagine that this is a wire copper structure that, it's like a tube of copper, I mean, that's looking just bent to look just like this. And if you could grab on to this part with your left hand and this part with your right hand, and you push upward this way, it's going to make the B wave go up this direction. So the future uptrend, the smaller the C wave is going to get and the bigger the B wave is going to get. And if the future trend is going to be bigger than the previous trend, so you have this advance coming this way, for the future trend to be bigger, you need the B wave to be at least similar to wave A and preferably bigger. C wave to not finish much below the bottom of wave A, and the higher the better. So the smaller the C wave is and the bigger the B wave is, the stronger the future trend. The smaller the B wave is and the bigger the C wave is, the weaker the future trend. So that's the way you should think of this, as a physical structure in the real world, and consider this like vector physics. You have a vector going down and it's longer. That indicates the future vector going up is going to not be as powerful. If this counter trend vector is very powerful and the downtrend vector is not very large, then it indicates the future up move is going to be stronger. So it all hinges on the behavior of wave B. The bigger the B wave is, the bigger the future move. The smaller the B wave is, the smaller the future move. Does that make sense to everybody? Let me see, I have some more questions coming in. Okay, so I answered Sukhet's question. Mohit, let me see, I'm going to unlock your mic here. Okay, so your mic is unlocked, Mohit. So, what's your question, Mohit?
What's the maximum time a wave we can take in a flat and a zigzag?
Okay, in a B wave, typically the B wave will be no more than 3 to 5 times the time of wave A. If it's more than 5 times the time of wave A, most likely you're dealing with a chart that's too complicated and you need to simplify it by going to a higher time frame. So, if wave A takes 10 days and wave B takes 100 days, you're going to want to simplify that chart to where the number of time units that the B wave takes is no more than about 5 times as many as the A wave. So that's the way you manage complexity, so that you're always controlling the way the market's behaving, so you can properly interpret what you're looking at. But generally it's between 300 to 500% with a properly drawn chart. Okay?
Okay. Thanks.
And so that question was both for flats and zigzags, right?
Yes.
So in a flat, the B wave can take more like 300 to 500%. In a zigzag, it's going to be more in the 100 to 250, 60% range. The longer the B wave takes, the much more likely you're dealing with a flat than a zigzag. Okay?
Mm. Okay. Thanks. Thanks.
Okay, so go ahead and put your mic on mute and let's move on to triangles. In a triangle, the structure is going to be all corrective. So most of the waves will be 61%. So wave B retraces at least 61% of wave A. Wave A wave C retraces at least 61% of B, and so forth through all the waves. B wave might be the exception. It might be less than 61% of wave D, but generally you're talking about 61% for most of the waves or more. And generally it's going to be somewhere in the 80% range if it's going perfectly horizontal. And every segment is corrective, of course, and it's going to have generally a contracting look to it, like this. There's also the expanding variety. We'll get into that in a minute. But most contracting triangles are going to be mostly horizontal, and the A wave will be the most violent move. This is very important you write this down. So for a contracting triangle, you want wave A to be the most violent wave of the entire pattern. In 30 I've seen an exception to this rule. If the A wave is not more violent than wave B, you're dealing with a different kind of triangle, you're dealing with something else. So it's not a sometimes thing, it's a mandatory thing. So wave A has to be more violent than wave B, and it should be the most violent and largest wave of the entire pattern. There is a chance that the B wave could be larger, but it has to be a lot slower. But 9 times out of 10, the A wave is going to be the most violent move and fastest move, followed by a much more drawn out B wave that could be 300 to 500% the time of wave A. Again, if it's beyond 500%, you're probably going to have to simplify your chart. Wavy in a triangle typically wouldn't be violent unless it starts with its own contracting triangle, and then the first phase of wavy could be violent, and then it goes into a contraction for its, the rest of its structure. But if you see wavy as a contracting triangle, most likely your pattern is too complicated, so you need to reduce the complexity of your chart. You don't want to have a lot of detail to where just the E wave itself is a clear triangle. That means the C wave and the D wave and the B wave and all the other waves are going to be much more complicated. So that would suggest you need to simplify the chart. But in a normal complexity controlled environment, the E wave is not going to be violent at all. It may break the trend line, so it may cause a little bit of scariness, but it's not going to be as violent as this, and certainly it's going to be much smaller. So typically it's going to go sideways. It's perfectly acceptable for the triangle to drift up or down. So it can drift up like this, it can drift down like this. It can even be where the B wave is making new highs and the D wave is making new highs. That would imply a lot of strength. So remember, when whatever the B wave is doing in a pattern tells you, hints you into the future strength of the pattern. So if the B wave is bigger than wave A, it means the thrust is going to be bigger than normal. It's probably going to be a little bit bigger than wave A of the contracting triangle. If the B wave is comfortably shorter, maybe around 61% of wave A, then that's a sign that the thrust may not be quite 100% of wave A. So always pay attention to what the B wave does in zigzags, flats, and triangles. That'll give you a very strong clue on how big the future move out of the correction is going to be. You should think of triangles as being on a pivot point where the apex point where the trend lines converge can move up or down. So again, it can drift up or down, but you're going to have 5 segments, and the most violent will be the first, and the B's and the D waves will be more complicated, more time consuming, and a lot less violent than wave A, C, and E. And the other thing that's very crucial, I don't know if it's mentioned in my book, but you want the C wave, probably 9 times out of 10, the C wave will be exactly 61% of wave A. And that's one of the clues you're going to get that you're in a triangle and not a flat or a zigzag, or not a flat situation, because the C wave will drop down and it'll be 61% of wave A, but it doesn't make a new low, or it's not close to the low. And that would be a warning that most likely the D wave is not going to be the start of the new uptrend. But having a perfect 61% relationship between wave A and C is a sign you're in a contracting triangle. Okay, let's move on to the next page. Another important thing is you don't want to have too many touch points. If you have too many touch points, you're probably dealing with a non-limiting triangle, or your count is wrong. So here it shows where we have 3 touch points on the top and 3 on the bottom, very, very unlikely this is going to be a contracting triangle, that something is going to happen to ruin the structure. This most likely would turn out to be a diametric, where you have A, B, C, D, and then the E wave is going to break down below this low and begin the expanding phase, and the F wave is going to go over here, and the G wave is going to go down here. So you go through contraction between A, B, C, and D, and then you go through expansion from E, F, and G. So just realize you don't want perfectly channeled triangles. If you do, it's going to be a non-limiting triangle, so it'll be the end of something, or it'll be an X wave. It won't be a B wave or a fourth wave. So you want it to be something like this, where the top channel gets broken going backwards in time, or it's missed where the pattern starts here, but it doesn't end on that line. And the bottom will have 2 touching and 1 that finishes above or below, but it won't finish on the line. These are very important concepts so that you don't anticipate the conclusion of something way before it's actually ready to finish. Okay, going to the next page. Another thing, you don't want to have false breaks of the trend line. So if what you think is the E wave breaks above here and then it goes back down and breaks this low, you can't have a sign of strength by breaking this line and making the B wave of wave E bigger than wave A, and then a sign of weakness by making it low. You can't get expansionary behavior inside of a larger contractionary environment. So you would not, if this broke here, either the E wave starting, the thrust is starting right away, or this low has to be above this one, so it shows strength, and then right after a little reaction, staying above this low, the market takes off. I would tolerate that, but I would not tolerate this. So if this happens, you just redraw the channel across this high and this future high and assume the E wave started here. Okay. Let's see. Here's an example where it is possible that the B wave is bigger than the A wave, but if the C wave is bigger than the A wave, then this is not what can be called a contraction triangle. This is what would be called a neutral triangle. I don't know if I recognize that when I did this in my book. I don't know if I mentioned this yet. I don't think I do, but this actually would not be a contracting triangle. So if wave C is larger than wave A and then wave E is more similar to wave A, this is like a third wave extension that goes sideways. So this would be like wave 1, 2, 3, 4 because of the overlap, and because wave 2 is bigger than wave 1, it can't be a 5-wave move. It'd have to be a triangle, but it'd be a neutral triangle. So if the C wave is bigger than the A wave, this is the only time in a triangle that wave A can be less violent. So only in a neutral triangle where the C wave is the biggest can wave A not be the most violent wave. In this pattern, wave C can be the most violent wave, and usually is. In a contracting or expanding triangle, wave A will always be the most violent wave. Okay, let's move on. All these variations aren't that important. It just deals with whether the pattern's drifting or not drifting. What becomes more important is discussing the non-limiting situation. So when you're dealing with non-limiting triangles, you're going to get certain kinds of behavior that you don't see in limiting triangles. So if a market's structure, I'm trying to find an example here. If a market structure goes into the apex point, then you're dealing with, what's going on here? There should be a diagram here. Let me see if I can find it in my book. I thought there was a diagram. Oh, the diagrams come next. So I may have to wait to do that. Let me go back a little bit here. I may have to close this page to get it to work. Let me just see if, okay, there you go. So again, remembering and trying to quantify all these different variations is just not that important. It's just a matter of whether the triangle drifts up or down. The variations aren't that critical. This doesn't look like where we were. Let me go back a little bit here. Okay, so that's where we were discussing that. So we're moving on to limiting triangles are going to be triangles that happen in the B wave or the fourth wave position only, and they're going to finish comfortably before you get to the apex point. So you have your contraction, it'll conclude, it'll thrust way before here, and the thrust will usually end right around where the apex point occurs. So that's what qualifies as a limiting triangle, because it happens in the B wave at the fourth wave position. So it's limiting the future movement. The thrust will be wave C, and that's the end of a bigger pattern, or wave 4, it's the end of wave 5 and the end of a bigger pattern. If it's an X wave, then it's just the start of another trend, and that's why I differentiated it between limiting, which would be a fifth wave, or C wave ending something. If it's an X wave, which would be a non-limiting triangle, then you get an ABC, so that first thrust doesn't end anything, it's just part of an ongoing move. So that's the difference between limiting and non-limiting. In a non-limiting, I don't see any diagrams here to go through. Triangle, you're much more likely to go into the apex point of the triangle, and I'm pretty sure I do have some examples. Let me just go a little further on. Okay, so here's some examples of flat. Let me get to the triangle page first. So here's an example of a non-limiting kind of triangle. This bottom section is for non-limiting triangles, and they're very likely to go into the apex point, and you may even get a contracting triangle for wave E that goes very close to the apex point. And then when it thrusts, this won't be the end of the future trend, it'll just be wave A of another bigger ABC. In a non-limiting triangle, the conclusion will happen probably a little bit earlier than what's shown here, just comfortably before the apex. So when the thrust happens, it finishes around the apex point. So that's the primary difference you usually see between non-limiting and limiting triangles. So let me go back a little bit. We need to discuss the channeling and Fibonacci relationships in patterns. So let's see. Sorry, I have to keep going back here, but it's the only way to get it to work. It won't go backwards very easily. So I have to jump backward and then go forward. Okay, so the post-triangular thrust is what I've already mentioned there. And when you're dealing with expanding triangles, again, you want the A wave to be the most violent wave. The C wave will be generally somewhere between 101 and 161% of wave A, but more similar than different, because the E wave is the wave that's going to be really big, and it'll generally be about 161% of wave A, or 161% of wave B or more, or 161% of the distance from the bottom of A to the top of C. So one of those three possibilities. So to be safe, when you're looking at what you think is an expanding triangle, just take 161% of wave A, add it to wave D, and that would be your minimum target. Do the same thing for wave C, that would be sort of your intermediate target. And then from the bottom of this to the top of this, that would be approximate maximum target. That's how you would calculate the three possibilities. So you might just want to have a minimum and maximum. And typically it's going to break above the AC trend line to create an overthrow and get everyone all excited. The market's just super powerful. It'll be very emotional around here, and the market starts selling off, of course, after that. I wouldn't spend too much time worrying about limiting or non-limiting expanding triangles. You're mostly going to see expanding triangles only in the B wave of a flat. You virtually never will see it in a zigzag. You might see it as an X wave, but only if the market's not going to trend very strong after. Remember, an expanding triangle is a pattern that doesn't have much future strength implied by its development, because the market's going wilder and wilder in the same range, and it sort of wears everyone out. And after it's over, just the markets don't tend to trend that powerfully after. So, I wouldn't worry too much about all the variations of expanding triangles. Just realize if you get one that the odds are extremely high, it's going to be the B wave of a flat. Okay, I have some more questions coming in here. Says Roy, while triangles are different to diagonals, do diagonals have some properties like triangles? Yes, the similarity between triangles and diagonals is that they're all a series of corrections. There's 5 corrections in a row. But the important clue is if you think it's a 1 and a 2, but 2 is bigger than 1, then that wipes out the terminal possibility. If what you think is 4 is bigger than 3, then that wipes out the terminal possibility. If the pattern mostly goes sideways, then that probably wipes out the terminal idea. You want terminals to generally go up, at an obvious upward angle. May not be strong, but an obvious upward angle or a downward angle. So if it's just mostly sideways, then you probably aren't dealing with a terminal. But if wave B is slightly shorter than wave A, and wave D is slightly shorter than wave C, and two of the waves that are in the direction of the trend look similar and one looks different, then you run into the potential of it being a terminal pattern. So then you want to make sure that does this, what looks like a terminal, could it possibly be the last leg of some much larger pattern that you're at the end of a major trend and a violent counter trend move is going to start? Or, are you in the middle of price action and it doesn't fit the possibility of being a terminal? So most important thing is just to look at the behavior between what you think is 2 and 4, B and D, and if either one of them is bigger than the prior one, then it can't be a terminal pattern. It would have to be a triangle. And just make sure it's occurring in a place that's allowed to occur. Normally, an expanding triangle would be a B wave or a fourth wave or an X wave. So that's a point in structure that's impossible to be a terminal. B wave can't be a terminal. Fourth wave can't be a terminal. A 2 wave can't be a terminal. X wave can't be a terminal. So you have to make sure it's in a position where a terminal is allowed, because a terminal is a 5-wave move. Okay. So why did you label the previous wave 1 and 3? So Panthem, I'm not quite getting the question. Let me go and unlock your mic. It's currently unlocked. And so do I need to go back or forth in the diagrams? What's your question? Your mic, it shows it's unlocked, so you have to unmute it on your end. And then look like it's working. I don't really quite get the question. It says in the page of triangle picture. So on this current page, or do I need to go back to the full page of dive triangles? Is that what you're talking about? That's probably what you're talking about. Let me go there. Okay, so this is the page you're talking about? Previous one. This is a bunch of flats. You want me to keep going back? Because to do that, I'm going to have to skip back. It's not going to allow me to go back normally. You can't unlock your mic? Let me try. It shows it's unlocked. If you could email it to me and maybe send me a picture of the page. I really don't quite understand what your question is. So we have to get to the questions and answers. So if you can either email me the question while I'm doing this other part, or send it to me later, we can go over it then. So let me get to the, let me see, I have to finish this section. It's malfunctioning. I may have to close it, I think, and reopen it. Okay, hold on. Okay. So I want to get to the diagram. To do with channeling and Fibonacci relationships, channeling is only important in corrections when you're starting with the top of wave A to the top of wave B, or the bottom of wave A to the bottom of wave B. And if it's a flat or zigzag, you're going to use parallel channeling. If it's a triangle, you're going to use contraction or expansion 9 times out of 10. If the C wave is the longest, then you're going to use parallel channeling for the triangle, and you're going to look for wave A and wave E to be similar. But generally, channeling in a flat or zigzag is always going to be just across 0, which is the start of wave A and the top of wave B, or the start of wave A and the bottom of wave B if you're going the other direction. And you're going to use a parallel line. And if the C wave reaches the opposing line, then the market's stronger. If it doesn't reach it, the market's weaker. If it's going in down direction, if it's going in upward direction, the C wave doesn't reach the bottom channel, then it's stronger. If it breaks below it, it's weaker. And those are important things to know about what the future move is going to be like. So the weaker the C wave, the less powerful the future move after. The stronger the C wave, the more powerful the move after. So that's the reason you use channeling, is to get an idea. Anthem, I can hear you now.
Yeah.
Okay, so you want to try to ask your question? So
it was page 5. It was page 5-40.
I don't have the page numbers here, but is it earlier than? Can you turn your volume down some so that it doesn't? We don't hear echo.
All right.
Turn your volume way down.
Okay, already turn it down.
Okay, so can you just tell me which diagram or what situation? Can you just explain it a little bit better so I understand what you're talking about?
It was a page with the many picture of triangles. I have
Yeah,
the
that was
books
only
on
one
me
page.
now.
I
I
showed you
have
that.
them.
That was this page right there.
Yeah, yeah, this page on the right side.
Yeah, that's where I
So
was a minute ago. You said no, not that
you see
page.
that on the
So
left.
what about
This? Yeah, you on it say you label wave 3 or A, right there.
Oh,
Wave
right.
3 or A.
Right.
And then the bottom you write X wave. So I wonder what's the difference. Do you mean
That's
like
because
the
these are limiting
previous wave?
triangles and these are B wave triangles. These are limiting triangles, which happen as wave 4 or wave B. These are non-limiting triangles, which happen at the end of patterns or as X waves.
Oh, okay. All right. So
Okay.
you meant non-limiting triangle.
Non-limiting is the
Okay.
bottom, limiting is the top. B waves and fourth waves at the top, X waves and conclusionary triangles at the bottom.
Okay. Thank you very much. Got it.
Go ahead and put your mic on mute. Let me go ahead and delete those questions. Okay, I'd like to get to some of the emails before we run out of time because we have skipped some of those. First of all, whoever made this chart, this is a very, very nice looking chart. This is the way wave charts should look. So they're all equally spaced apart. We're, plotting. You can see nothing looks weird about it. It has a nice flow to it. Everything's equally spaced apart. That's how a wave chart should be drawn. So one thing I've noticed that a lot of y'all are doing, you're going through and placing all these 5s and 3s going all the way forward in time. That's very premature because you don't want to go too far into the future because you have to start combining patterns to see how they fit with the future. So for example, there was I think a diagram here if I can find it. I have to go back to my emails. I had it earlier, but I don't see it. Give me a second to open up my email again. I think it was Panchai's email. Single wave patterns. Where did that chart go? I don't know where in the hell it went. Let me try this one. No. Gosh. Must have been this one. Okay, yeah. So here you can see where, let's see who sent me this. This was Laban. Let me unlock your mic. So if Laban, you want to unlock your microphone, you can. But this is an example of going to way too much trouble forward in time until you've dealt with the more current action. So on this chart, you would start off with your 3, your 3, your 5, your 3, your 5, your 3, and then this 5. And that, could have been possible. Then the market retraces a substantial portion of it. This tells you that whatever all this was, it's now finished because you've gotten to move bigger and faster by a massive amount than these reactions here. So that immediately means you need to solidify the conclusion of something and the start of something else. So when you conclude this movement, I would look at this and think most likely there was a flat here, so an ABC flat, an X wave, and then an ABC zigzag. And this whole thing would become one complex correction. It can't be a zigzag because there's no alternation, really barely any alternation between 2 and 4. I don't know if there's an extended wave. Let me just double check. Hold on 1 second. Yeah, I mean, this does qualify wave, but there's no alternation in time or complexity and very little price retracement. And this is way less than a third of this, and this is less than a third of that. So you're dealing with very suspicious impulsive action. And then the decline takes more time to get down to this low than it took to go from here to here. So there's lack of stage 2 confirmation. There's a lack of a break. If you had a 2-4 trend line going through here, it didn't touch the 2-4 trend line in the same amount of time or less. So all that tells you this is not an impulsive pattern. You should move this rectangle to start to here, and I would count this as a complex corrective rally. It may not even be a flat X wave and a zigzag, but it is a complex corrective rally, and it's concluded. So this entire structure would be compacted to just a colon 3. And then you have immediately the correction. And when you're going through a counter trend move, you can see that the up move was larger and faster than the down move. So you know that this is the trendier move and this is the correction of that move, right? This went up way faster than all of this mess. So you know the trend is up. So this correction would be called wave A, and all of this would be called wave B. So that's when you would have to put in some timing. If you measure this rectangle right here and you start it here, measure the entire time, you would not assume the B wave could possibly conclude until it's taken at least this much time, because a B wave needs to take the same amount of time or more as an A wave. So this rectangle would be approximately the first moment I would have considered even the possibility that the B wave could have finished. And when you look at this decline, if you were to call this a 5-wave move, you can't call this a 5-wave move, because this 5-wave move would have to break this 5-wave low. Otherwise, you can't call this a zigzag. Remember, in a C wave of a zigzag, the C wave has to break this low. The fact that it didn't means something else is going on, okay? So first thing you would notice is that it never, that it didn't take enough time before it could have finished anything. Then it kept bouncing around. Maybe, I don't know what this is exactly. Sometimes it takes a while to figure out this kind of stuff, but maybe this is a zigzag. This might be an X wave. These are a bunch of just corrective patterns. That's all you know. And it's not going to be part of a new uptrend until you can get a clean trend line that goes across some low that does not get broken, and the market starts to advance at a rate that makes some kind of sense. So this chart doesn't look like it's on a log scale. It needs to be a log scale to make any sense, because it's covered way too much price territory. But you would draw a trend line on a log scale across this low and this low here, and then a parallel across this high. And this doesn't really look like a Bitcoin chart to me, because I've seen Bitcoin charts. There looks something very strange about this chart. But if this were real data, I would look at this and say, well, this is a very violent move. This is probably wave A of a contracting triangle. This is wave B. This is wave C, which is probably somewhere close to 61% of wave A. If I measure wave A from the bottom over here to the high, take 61%, and you finish wave A here, it's exactly 61% from this point to this point. And then we've retraced a lot of that. So most likely this is some kind of contracting triangle, wave A, wave B, wave C, wave D. But this chart's getting pretty complicated, and the time of wave B is getting pretty extreme in relation to wave A. So I would move to probably a 6-monthly chart, get wave A to be a mono wave. The B wave will simplify quite dramatically, and this will start to look more manageable and controllable. And then you can figure out what that big structure is. And once you know what the big structure is, you would start over here with whatever wave C and D and E are doing and try to figure out when they're going to finish. But this chart does not look right to me. I've seen Bitcoin charts, and there's something not right about this chart. I don't know why it looks so strange, but maybe you're missing a lot of historical data, and definitely because it's not a log scale, it just doesn't look quite right. So make sure when you go through this analysis again, you do it on a log scale, and don't go through the entire chart labeling everything. Start off and go step by step, and as things happen, you need to adjust and figure out, well, something ended, something new started, and then you start with the analysis until something important there ends, and you start again. You don't want to just start labeling the entire chart the way you've done here. Okay, we have some questions coming in. How do we take the time of a wave from pattern start to? Generally, time is measured from lowest to highest point of the structure. Once in a while, you have to take the secondary approach of measuring it from the beginning to the end of the structure, but 9 times out of 10, it's going to be from the lowest point to the highest point, and then you relate that to what happens after from the highest point to the lowest point. So that answers Mohit's question. Roy has a question here. Generally, if one is confused with the pattern, it's most likely a triangle, and if it's triangle, often a fourth wave. How reasonable? I said, yeah, I wouldn't say you can depend on that. I would say if you're confused about where you are, 9 times out of 10, you're nowhere near the end of a pattern. So if you're confused, you're usually in the third wave of an impulsive pattern, the B wave of a flat, the C wave of a triangle, the D wave of a diametric, or the X wave of a complex formation. So the deeper you are inside of a correction or impulsive pattern, the more confusing you're going to be, the more scenarios you're going to have, the more you're going to be sort of unsure what's going to happen next. So realize uncertainty means whatever has been going on is unfinished. So if it's been going sideways and you're getting more and more unsure, then it's probably going to keep going sideways. If it's been trending up and you're getting more and more unsure, it's going to keep trending up. So during the uncertain periods, just be patient and expect the market to continue what it was doing previously the first 50% before you got confused. So if it's been going, if you were really clear about what was going on for say 100 days, and then it starts getting more and more confusing, then you take the amount of time when you were clear all the way till you got the most confused, and it's going to probably go that much longer into the future before it clears up. So I hope that answers that question, Roy. Okay, so Laban says his internet's too slow to ask questions. Okay, as far as how to plot in Excel, you know, we don't provide any other charts except for the S&P gold, T-notes, and the euro currency. But to do the plotting, you just want to do a vertical placement of the data. See if I can find one in here. So this is something Stefan, of course, wrote for me, and it's automatically, he has a website that downloads cache data off the internet, and it stores it for me to automatically, you know, plot it out. But this is how you do it. You would have column A for dates, and you want to have 2 dates per period. So, you know, August, it'd be the low and the high, or the high and the low. In the September, or for a day, it would be the same day twice for the high and low for the same day. And then you plot them vertically in section B, high to low, low to high, high to low, whatever. The third column is just the close. You don't need to worry about that. And when you do it this way, then the market will plot out price action like that. You may have to call Excel on how to get it to work, but generally you can select a certain price range and then you go to plot it. But I haven't had to do this in so long, I don't quite remember exactly how to do it. It's just already done for me. So this is how they'll look when the data is in sequence, vertical sequence like this, and it plots them in a nice wave kind of structure. Okay, so that takes care of that. Takes care of that. Let me close this, and I think that is just about all the questions. This chart's way too complicated, so whoever did this, you have to realize what you're doing is you're just personally deciding which highs and lows are important. That's not going to produce good wave structure. You're missing a lot of highs and lows in here that are important. You're missing the time variable that's important. This is not a good chart to do wave analysis on, so I would not attempt it on a chart like that. This chart's not done on a log scale, so you're not going to be able to analyze it properly. That chart's very complicated. I've already gone over that. I've already gone over this. So I'm only left with this same chart, which is twice now. So let's see if I can see what the question is, and then we're going to have to call it a day. I would like to ask you why you think the pattern in the red circle is corrective. Okay, because you can see we had a very trendy move that was larger than this declining move that was completely retraced. So you know this is larger and faster than this counter trend move, which is smaller and slower. So you know the general trend is up, whether this is wave A or wave 1, the trend is up. And then when you go to measure the retracement, you know it's too much to be wave 1 unless you're in a terminal pattern. But chances are pretty high it's going to be wave A because it's retraced more than 61%. Based on channeling, it'd be very unlikely that the trend started here because this retraces too much. So most likely whatever this is going on here started either here or here. and that's where wave A began. So I would have this as the start of wave A, first really powerful kickoff that goes above the previous high. Probably a complex corrective rally, maybe a double zigzag, not really quite sure, but it can't be impulsive because it's retraced too much. The only way it could be impulsive is if this is the fifth wave of some larger pattern, and this is starting a larger correction, but it doesn't really matter because this would still be wave A in this area, probably either here or here, and this would be wave B. So it has to do with how much it's retraced and the behavior being much choppier and more, you know, congestive and less trendy than what we saw here. So if this is impulsive, then this is the start of a prolonged correction that is correcting something that's much bigger. So if this is wave 5, then this somewhere in here would be wave 4 and 3 and 2 and 1. And this would be a whole correction where this entire high would be wave 1 or wave A or wave 3 or wave 5. This is the beginning of a very prolonged sideways period. Let's see the other question. I don't really quite understand this question, but you're using longer term time frames to simplify structure. So this structure is not too complicated, but it's getting there. So if it was more than 55, you would simplify it to a less, you know, detailed chart. So the way you broke it down here is proper. You would look at this chart and say, well, most likely this is wave A of some bigger pattern, or if it's the fifth wave, this is still wave A of some very large correction. So it doesn't matter what this high is. This would be wave A. This whole rally would be a B wave rally. You would eventually expect a C wave decline, whether it makes new highs or not. So your goal right now would be not to start the analysis from here, but to start it from right in this area. I don't know if you're doing that here. It can't quite. This looks like it's right here. So you probably need to go a little bit further back in time. And I would begin the analysis somewhere in this area, preferably from the low, just to make sure. So you would take this half yearly chart, start at this low, figure out where the A wave actually ended, which is going to be somewhere later on than this low. And that's where the analysis for wave B begins. And I would do the analysis on this chart first to try to get an idea of what might be happening. But if it's not enough detail to figure it out, then I would move to the half yearly chart. It'll give you more detail and give you a little bit of a better idea what might be happening. But this takes time. It's not something you can just throw together in a few minutes. Okay, so let's go ahead and call it a day. That was the last email that I had to open. If you have any new charts, then go ahead and send those. Let me get rid of these. I think, let's see, Evgeny has questions. What is the principal difference between a neutral triangle and a contracting horizontal triangle? Okay, a neutral triangle is where the C wave is the longest. Contracting triangle is where the A wave is the longest. An expanding triangle is where the E wave is the longest. That is the only way to determine what kind of triangle you're in. Which wave is the longest in the direction of the trend, A, C, or E? Once you know which one is the longest, then you know what kind of triangle you're in if you're in a triangle. Okay, so that answers that question. So let's call it a day, and we will pick this up with the next chapter. We may have a page or two to go. We didn't quite finish chapter 5, but we have a page or two to go before we go on to the next section, which will be chapter 6. Chapter 6 is a pretty simple chapter. It has to do with confirmation, but we'll get into that next time. So let's call it a day, and I will speak to y'all next week.